Hi guys, welcome back. This week we're going to be talking about whether you should be prepaying your mortgage or not. The goal of this video is to make sure that you have enough information so that you can make an informed decision on deciding if you should prepay your mortgage or if you should continue to make the monthly payments as scheduled. Now, what would be some of the benefits and some of the disadvantages of prepaying your mortgage? So we're going to start with the benefits of prepaying your mortgage. For most of us, the highest expense that we incur on a monthly basis, it's housing costs, whether it's rent or whether it's your mortgage. For most people, they feel like if they are able to prepay their mortgage ahead of schedule, then they'll be able to free themselves of their largest expense on a monthly basis. And for many people, being able to achieve something like that would make them feel like it's a huge weight off of their shoulders. And that alone is the huge motivator for many people to prepay their mortgage to make sure that it gets paid off ahead of schedule. And sometimes years before they were supposed to make their last monthly payment. So the most obvious reason is this. It means that they no longer have a mortgage payment. And because they no longer have a mortgage payment, they don't have to deal with the worry of possibly losing their homes in case they cannot make any payments. Now, of course, not being able to make your monthly mortgage payment is not the only reason why you may lose your house. Even with a mortgage that is paid off, it's still possible if you are unable to pay the property taxes on that particular property every year. Now, another benefit of prepaying your mortgage to make sure that you get it paid off early is that once that mortgage is paid off, let's say your mortgage payment was $2,000 a month. That is $2,000 extra dollars that you have freed up so that you can do whatever you want with. Whether you want to use that money to travel, to invest, basically to pretty much do whatever you want. And because you no longer have that debt obligation of having to pay $2,000 a month, working towards any other financial goals that you may have can be accelerated with those two extra $1,000. Now, yet another benefit of prepaying your mortgage is that you will end up paying less money in interest over the course of the loan. For example, if you had a 30-year mortgage and you paid it as expected or as scheduled, according to your amortization schedule, over the 30-year period, depending on the amount of your mortgage, it is very likely that you would have paid hundreds of thousands of dollars in interest alone. So instead of paying off the mortgage as scheduled, if by making extra payments towards principal, you end up paying it in 20 years, you may be able to save over $100,000 in interest payments. So if you're someone who hates paying interest on anything, let's say it's credit card, student loans, car payment, and mortgages, paying off your mortgage early will be attractive to you for that reason. Another benefit of making prepayments towards your mortgage to get it paid off is that your current mortgage may have an interest rate of say 5% or more. And because this video is being recorded in mid-2023, it's possible that interest rates will continue to rise even higher. So if you were to get a new mortgage and your interest rate ends up being 6.5% or 7%, you may decide that if you have the extra income, you will start making prepayments on your mortgage just so that you can get out of that loan as soon as you possibly can. And by contrast, if you are able to get a mortgage refinance or the original mortgage at 2.6% for a 30-year mortgage, it may not make much sense to pay off that mortgage because your interest rate is so low. Then you can invest the extra payment that you are going to make towards principal to pay down that mortgage and invest it elsewhere and be able to get a higher rate of return. Currently, even a savings account can pay you 3-4% or even higher on your money. So it would not make sense if you can earn a higher interest elsewhere to pay down or pay off a mortgage with such low interest rates. Another reason why you might want to make prepayments towards your mortgage so that you can reduce the principal is that when you purchase the house, your down payment was less than 20%. And typically, if your down payment is less than 20%, your lender will require that you pay PMI, which is private mortgage insurance. What that is, it's simply insurance for which you're making the monthly premium payment. However, it is to the benefit of the lender in case you default. So if for whatever reason you purchase the house and you only put down 5%, the lender that is lending you that money wants to make sure that because you have such low equity in the house, you don't have a lot of money that you put in as a down payment, you may for whatever reason stop paying the mortgage. And if that happens, the lender wants to make sure that there's an insurance in place to make them whole, basically, so that they don't end up losing money out of that deal or that transaction. And generally, once you are able to make enough prepayments towards principal to reduce the principal balance of that mortgage, while at the same time having the house appreciate in value, reaching 20% equity, you may end up reaching the point where you have 20% equity in that house and be able to request that your lender drop PMI so that you no longer have to pay the private mortgage insurance. For example, if your private mortgage insurance was $150 a month, over the course of 12 months, you no longer have to pay these $1,800. Now, I am certain that there are additional benefits that you would get by prepaying your mortgage so that you can get it paid off early. These are the main reasons why most people would generally want to make extra payments towards principal so that they can reduce the principal balance. Now, in case this is not clear, I just want to make sure that I clarify that for you. What I mean by principal balance is a mortgage payment that you typically make to your lender is comprised of interest that you're paying towards the bank. Part of it is principal, and part of it may be PMI, and part of it is for your escrow, where you put money towards your escrow account so that your mortgage lender can pay your property taxes and the homeowner's insurance policy for that house. So in addition to making your regular mortgage payment, which is comprised of those, you can make extra payments, say let's say $200 extra per month, and you specifically request that it be put towards principal and not towards your next monthly payment that is due. If you plan on prepaying your mortgage, it is absolutely crucial that you make sure that the extra money being paid gets applied to your principal balance, meaning to reduce your principal balance while you continue to make your regular monthly payments. Now let's move on to some of the disadvantages of prepaying your mortgage. Some of the disadvantages of prepaying your mortgage include the following. As soon as you send the extra amount to be applied towards principal, therefore increasing your equity in that house, meaning how much of that house is actually yours, you no longer have access to that money. Yes, you have it in equity. If the value of your property increases, you end up owning more and more of that house as you make extra mortgage payments, meaning you owe the lender less and less. It's no longer accessible to you because now it is part of an illiquid asset, meaning that asset is not easily converted to cash. So if you wanted to get the full value of your equity, meaning your entire equity out of that house, you would have to plan on moving and you'd have to put the house up for sale so that you can sell it and then you get the cash. An alternate method might be for you to take a home equity line of credit, which is basically having a small additional mortgage on that house. But the main reason why this is a disadvantage, it's because of the fact that you no longer have access to that money. Once you've put it towards paying down your principal, you cannot easily access it as you would if it were invested in stocks, for example, or if it were invested in some other liquid asset, either cash or easily converted into cash. Now, another disadvantage of prepaying your mortgage is that generally, if you have a mortgage on your primary residence, there's interest that you're paying every month. So like I said, there are many components to that monthly payment. So some of it is interest, some of it is principal. So the more you pay down your principal, the less interest you end up paying any subsequent month. Meaning with every mortgage payment that you make, you have more money going towards principal and less money going towards interest. And generally, interest that is paid towards that mortgage would be considered tax deductible, meaning when you file taxes, you would receive some kind of deduction, mortgage interest deduction off of your taxes. Basically, that would reduce your tax liability, meaning you'd end up owing the IRS less money. So as the interest amount that you pay yearly for that mortgage decreases, the mortgage interest deduction that you get would decrease as well, meaning that your tax liability would be slightly higher. Now, another disadvantage of prepaying your mortgage is the opportunity cost. So if you're using extra money to put towards principal, that money could have, in theory, be used elsewhere and invested elsewhere, right? So the opportunity cost is that, yes, you're gaining some benefits by increasing equity, but at the same time, you are losing, or rather you are foregoing the ability to invest that money in, say, the stock market and have those assets appreciate in value. That by paying down the principal, you are losing the ability to make money off of that money by investing it elsewhere, like in the stock market. Now, to demonstrate that to you a little bit better, I'm just gonna exaggerate a little bit. Let's say you were paying $200 per month extra towards your principal. That's $2,400 per year. So you no longer have that money available to you. It's not in cash because you've put it towards the equity of your house. But if you had invested those $2,400, like I said, I'm going to exaggerate a little bit, and you could invest it in a particular stock, and after just a year, the $2,400 appreciates to $15,000, you basically lose or miss out on the opportunity or the ability to make those $12,600 that it would have appreciated had you invested the money. And I'm hoping that makes sense. Now, another disadvantage of prepaying your mortgage goes back to the same opportunity cost, but not relating to investing. If those extra $200 a month that you're putting towards the mortgage principal to pay it down would be more useful for you to be able to save for a vacation, for example, or for you to be able to save to purchase your next car, then evidently you are not going to be able to do that as fast as you would have wanted because the money is simply not there for you to save those extra $200 a month towards that particular financial goal. So these are the primary benefits and disadvantages of prepaying your mortgage. Now that you have that information, I am hoping that you'll be able to make an informed decision to decide which of those you'd rather do. Now, in all transparency, personally, I used to prepay my mortgage so that I can reduce the principal, therefore having more equity in the house, because my interest rate on the house at the time of purchase was much higher. But since I was able to refinance to an extremely low interest rate, it no longer makes sense for me financially or mathematically to pay down the principal. Even though I could still choose to continue to pay it down because let's say I valued having a paid off house as something that would relieve a lot of stress, knowing that I owned my house outright. Now, in case you want to pay down your mortgage, I'm going to leave you with one tip that you can use. So instead of making 12 monthly payments to your mortgage lender for the 12 months in the year, you can actually pay them bi-weekly and end up making one extra monthly payment per year, which may help you pay off that house a few years earlier than scheduled. And the math is pretty simple. Let's say my mortgage is $2,000 a month. Instead of paying $2,000 a month, I would pay them $1,000 every 2 weeks. So with the 12 payments, that would be 12 times $2,000 a month, which would be $24,000. But if I pay them $1,000, which is half of the mortgage payment, and I paid them every 2 weeks for 26 pay periods, then I'll end up paying $26,000, which is $2,000 extra over the $24,000, essentially making one extra mortgage payment for the year. So that's it. Hopefully this video was informative to you. If it was, please comment, like, share, and subscribe, as it really does help me grow the channel so that I can continue to make these videos for you guys and continue to help you make more informed decisions as you become more financially literate. Once again, please subscribe below and hit the bell button so that you can be notified every time I release a new video. I'll see you next time. Have a good one.